I want to move on to the Yardi report, Yardi Matrix National Multifamily Report for October 2025. We feature Yardi's report when they come out here on the Gray Report as a really good baseline. Just to cover kind of three topics, multifamily rents continue to drop in October in face of weakening demand amid economic uncertainty and deteriorating consumer health. The average U.S. advertised rent fell $4 to $17.43 during the month, while year-over-year rent growth was unchanged at 0.5%. And then, although too soon for alarm, apartment demand is showing cracks. Absorption rates dropped sharply in recent months in Midwest metros such as Detroit, Twin Cities, and Indianapolis. In Sunbelt markets, including Orlando, Nashville, Miami, Southwest Florida, and Dallas. So again, as supply has really receding, we're also seeing demand recede as well. And just to fast forward a little bit, again, we're starting to see that dip really kind of come down. But looking at some of these year-over-year charts, again, the average rent growth according to Yardi, all asset classes for the year is 0.5. That may turn basically flat by the end of the year. And we do still have many Midwestern metros and other markets that are positive, but most are negative. We are also seeing a trend. Now I'm going to go to month over month numbers. The month over month looks much worse than the year over year. The year over year just looks not great, but there's still some positivity. New York's at 5%, Chicago's just below 5%. 3.8% is the 10-year national average. That includes the peak during COVID. But man, Griffin, look at this month over month. Really negative. There's really only there's barely like two markets that are positive: Detroit and New Jersey, which interesting pair. Something that I found interesting is it really is the higher end lifestyle asset class, which is all the new stuff, that is detracting from the overall averages, where we see kind of the renters by necessity having a little bit of growth, albeit not a ton of growth. So I mean, like Kansas City's got some nice growth, Chicago, Detroit, it's somewhat positive, but I mean, the lifestyle asset class, everything's negative, including New Jersey, including San Francisco. The national average, is 0.3% on the lifestyle stuff.
It's just quite interesting. You're an investor with Gray Capital, a sponsor that operates in different markets, and you're probably seeing a lot of the same thing in your monthly or quarterly reports relative to maybe sub pro forma rent growths, maybe just a deceleration overall cash flow, maybe your distribution wasn't as promised. I think that there's a relative kind of position that all LPs should be taking, currently, and it's not lowering the expectation bar, but it's maybe changing your palette moving forward into 26 with the understanding that the multifamily asset class and the markets are relatively not underperforming, but they're relatively flat or slower growth. And I just think that as an individual that gets to talk to investors, it's trying to articulate that in a way that sets expectations up appropriately. And so we're not having to deal with any backlash in regards to underperformance. And I don't think that our portfolio specifically is underperforming, but I do see all of these, emails coming through from sponsors, from individuals that are advising LPs on deals. Hey, you got the capital call email, you got your third capital call email, what to do when this is happening to you. And so I think that there's a lot of exposure in the media and in different newsletters and various outlets that are portraying the multifamily asset classes experiencing significant deceleration or significant lack of performance and a negative trend. And I just don't think that's the case. Obviously, month by month, month over month, it looks a little bit more significant. But like we said, year over year, it's relatively flat.
Yeah, year over year, according to Yardi, rent growth is flat with many markets still posting gains, including in New York City. I think, again, here's a contrast. In New York City, year over year, all asset classes, top of the list, almost 5%. Month over month, though, New York City's at the bottom of the list. Just, in 1 month, rents have declined almost by 2%. I don't think that's Donnie just yet. I don't know exactly. I can't really explain that. It's even knocking out Austin and Denver, some negative rent growth. Really, really fascinating. I don't know if it's supply. I don't know what it is. But Yeah, New York City is getting a little bit of rent relief from renters. Well, just as a reminder, you can get all these reports sent to you on a consistent basis. That's exactly what the Gray Report newsletter was originally designed to do. We were sitting around saying, "Hey, why aren't?" Honestly, the reason why we started sending out the newsletter is I hated finding these research reports months after they were published. They would be stale. There was no place that kind of aggregated all of them, and the outlets themselves didn't do a great job of like announcing that they had a new report out. So the dissemination was really bad. And I was like, well, this is going to be a lot of work putting all these, finding these reports, putting them all in one place. I'm like, if it's such a big issue for me, I was like, there's going to be other people out there that are going to want these reports sent to them in a timely manner. So we just started aggregating the reports ourselves and then started distributing them to our investors, partners, and friends. And that's how the Gray Report newsletter started. It eventually turned into the podcast where we talk about kind of the highlights on the report. But again, if you want to stay up to date with the best multifamily intelligence, the Gray Report newsletter, hands down, is the place to do it. You can subscribe by going to the Gray Capital website, graycapitalllc.com. Sign up. While you're there, you can also get this Midwest multifamily forecast report that we've been talking about, as well as sign up for the webinar that's going to take place on December 16th at 2 p.m. Eastern. It's going to be a blockbuster. So we talked about John Chapman, data scientist here at Gray Capital. He's going to be here, and he's going to just be blowing the roof off the thing, digging right into the data, getting into the methodology and what's driving some of these markets. Griffin, we're going to wrap up for today. Any other thoughts? Reading through all of this, again, official welcome to the Gray Report, sitting in as co-host officially. But any other thoughts on the multifamily market?
Click the link, subscribe. Excited for 2026. We love to hear your thoughts on our markets forecast report. If you have any questions, my email's in the bottom right-hand corner. It's always open and accessible to you. Would love to have a discussion on the report.
Thank you, Griffin, for that. And let me ask you this. Are there going to be some physical versions of this besides this one I printed out?
Sure. Absolutely.
If someone emails you, and I'm saying this because it's the end of the podcast.
Yeah.
So if someone emails Griffin and they're like, send me the physical version of this report. I don't want a PDF. I want to feel it between my fingers.
Right.
Will
you get a physical.
Will we send them
physical
one?
Copy and a hat from Gray Capital because you made it to the end of the podcast. Okay. Thanks for joining us this far.
Not just an actual physical version of the report that it looks great on a coffee table. It rolls up right into a stocking for Christmas. But you'll also be able to get a hat, which the Gray Capital hats, chef's kiss. They're great. A lot of time and effort goes into them.
They are.
I wear mine all the time. for a variety of reasons.
Right.
Mostly because it's a good hat.
We're going to have them on next week on the podcast.
We're going to have them on next week. And I know what I'm looking forward to in my stocking this year at Christmas is a research report. Yeah. All right. Thanks for watching the Gray Report. Hop on the Gray Capital website. We'll see you next week.